Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of April 14th. As usual, thank you for joining us. If you find these videos helpful or informative, make sure you like and subscribe below. And don't forget to check out some of the other great videos that we have on the channel. So as always, my goal for these videos is to use my background in economics to help you better understand the economy and the financial markets so you can make informed financial decisions. So with that said, let's get ready to hit the books and get up to speed on the markets. So as usual, we'll start by taking a look back at last week. Of course, the headline from last week was the Trump tariffs. The panic surrounding Trump's reciprocal tariffs reached an apex on Wednesday, at which point the president chose to put a 90-day pause on all of his reciprocal tariffs on the majority of U.S. trading partners, as well as some remote islands predominantly occupied by penguins. The pause applied to the majority of reciprocal tariffs, but did not apply to the 10% across-the-board tariffs on all imported goods. They also did not apply to the ongoing tariffs and trade war with China. By the end of the week, we saw that the Chinese tariffs had reached 145%, and the Chinese retaliatory tariffs against the U.S. had reached 125%. Stock markets absolutely took off on Wednesday after the announcement of the 90-day pause on the tariffs, actually posting one of the largest one-day gains in history. Following the jubilation on Wednesday, we saw a slight fall back to a downward trend in general on Thursday, with a slight recovery positive gain on Friday, ultimately leaving the markets up in an overall gain by the end of the week. Switching our attention to inflation, we saw the Consumer Price Index and the Producer Price Index released this week, and both came in below expectations. Inflation levels reflected by the Consumer Price Index were significantly lower than analysts had expected, in part driven by a significant drop in prices for gasoline and travel-related goods and services. Although lower inflation is certainly a positive thing and definitely a moment to appreciate, there are still some ongoing concerns as to why these reports may not have been as positive or optimistic as they seemed at first. The first is that these reports most likely did not capture the full effect of the recent tariffs that have been implemented in both March and April. The second reason for concern is that seeing prices fall actually fits the narrative that the economy overall is slowing down, demand is decreasing, and we may see downward price pressures as a result. So it's possible that we will see lower inflation, but we may see lower inflation as the economy slips into recession, which is ultimately not the outcome that we would prefer to see. Along these same lines, we also saw a significant drop in consumer credit. In fact, the overall level of consumer credit, or the amount that consumers owed, dropped by about $1 billion. This potentially aligns with the recession narrative that consumers are choosing to save as opposed to spend or borrow funds, and the consumers may be pushing down or paying down their debt out of concern for potential future recessionary problems or potential future job loss. We also saw the monthly Small Business Optimism report last week, and unfortunately, small businesses are also becoming more pessimistic. We saw significant drops in business expectations for both revenue and business activity in 2025. We also saw ongoing concerns within the small business community surrounding hiring, taxes, most likely meaning tariffs for many respondents, and the potential for higher input costs and higher inflation. Along these same lines, we saw the Small Business Real Sales Expectations Index drop for the third month in a row. Not to relish in this growing sense of pessimism, but we also saw the preliminary report for consumer sentiment for the month of April released last week, and unfortunately, the pessimism continued to spread. The Consumer Sentiment Index dropped for the fourth straight month. It dropped about approximately 11% from its already diminished level in March, and it also showed continuing declines in consumer expectations for business activity, incomes, personal finance, inflation, and unemployment. And in fact, the unemployment index hit the highest level we've seen since 2009. In addition, we saw that the short-term 12-month inflation expectation increased by a historical amount from 5% to 6.7%. And we saw the long-term inflation expectation, meaning over the next 3 to 5 years, increase from 4.1 to 4.4%. Unfortunately, as the pessimism continues to grow, the big question continues to be, when will consumers stop spending and start to acknowledge some of their pessimistic concerns through their actual economic activities? Switching our attention to the stock market and a more optimistic piece of news, all three major stock indices were up for the week, in large part as a result of the massive gains experienced on Wednesday following the announcement that the Trump tariffs would be paused for 90 days. Although Wednesday's gains powered the indices to an overall gain for the week, there were several other days where we saw the markets drop, and moving through the end of the week, we saw a great deal of confusion and high levels of volatility that will most likely continue into this week. Where a lot of attention was actually focused throughout the week, despite the dramatic changes in the stock market, was in fact in the bond market. A significant sell-off early in the week, in fact, has been suggested as one of the possible motivating factors for the 90-day pause in tariffs. We saw the yield on the 10-year Treasury drop following the announcement of the tariffs, which is to be expected. But what was unexpected was the dramatic gains, the dramatic increase in the yield of 10-year Treasuries following an enormous sell-off in the market for long-term debt, in part motivated by concerns of a global and a U.S. economic slowdown in the near future. Several analysts have mentioned that the sell-off in these Treasury markets has actually suggested that these bonds may not be looked at by investors as the safe haven that they have been historically. Given the turmoil in the United States markets, the United States economy, and United States economic policy, it's possible that some of the safety or assurity that folks felt with U.S. Treasuries has now been diminished. In light of increased concerns about the safety or the risk associated with U.S. Treasuries, the big question is, where do investors turn for that same safe haven opportunity? And the data from last week suggests that they've turned back to a classic, which would be precious metals and specifically the market for gold. In fact, the market for gold had a historic week showing huge gains and exceeding the $3,200 mark per ounce of gold. Where we did not see investors turning, generally speaking, was some of the more risk-prone assets, such as cryptocurrency. And in fact, we saw a significant drop in the value of Bitcoin, at one point dropping below $75,000 a coin, with a slight recovery towards the end of the week back up to around $82,000 a coin. Bitcoin has been operating in a very narrow margin between $77,000 and $87,000 for quite a while now. So the question becomes, will Bitcoin break out in an upward or downward trajectory over the next few weeks? Some of the other alternative markets we could look at: crude oil had an absolutely awful week, in fact, hitting record lows and posting significant drops throughout the week. And the US dollar also saw significant drops, at one point dropping to a level that we haven't seen since 2008. As investors move from riskier assets to potential safe havens, the question becomes, how will these dollars move? Will they move out of US markets entirely? And will they eventually move back into the US market following some of the first quarter earnings reports and the actual hard economic data that'll be released over the next few weeks? On that note, why don't we go ahead and shift our focus to this week? So at the end of last week, we saw earnings season for the first quarter of 2025 kick off with a few large financial organizations. This week, we'll continue to see several major financial players reporting their first quarter earnings, including Goldman Sachs, Bank of America, and Citigroup. But in addition to the financial sector, overall, we'll see about 30 of the S&P 500 companies reporting this week. And this will include some retail giants, such as Johnson & Johnson and Netflix. It'll include healthcare giant United Health Group. It'll also include real estate giant Prologis. And all eyes at the end of this week, of course, and throughout the first quarter earnings season, are going to not just be on the performance in the first quarter and any potential pullback by consumers, but also on the forward guidance as far as earnings and sales for the rest of 2025. The question, of course, is not just how did we do in the first quarter of the year, but how do the companies feel or believe their performance will change as we move throughout 2025. Turning our attention to the economic reports for this week, we'll see inflation reports for import and export prices this week, as well as potential new tariff announcements. We'll also see several pieces of information for the housing market, including the National Housing Market Index, the new level of building permits for last month, and the new level of housing starts for last month. Of course, a lot of attention from the economics community will be focused primarily on consumers and manufacturing. In fact, this week, we'll see an incredibly important retail sales report. We'll also see reports on production and capacity utilization. And we'll see manufacturing surveys out of both the New York and Philadelphia Federal Reserve Banks. Zooming out as we wrap things up to look ahead into the future, it's important to remember that although the biggest portion of the Trump reciprocal tariffs have been paused for 90 days, this doesn't mean that they are gone forever. Also, with the 10% baseline additional tariff on all imports and the 145% tariff on Chinese-made goods and services, we're still at a tariff level that's about equal, if not possibly exceeding, the level that we saw around the Great Depression. The big question in the economic data is whether these massive increases in taxes on U.S. businesses and consumers will immediately result in a slowdown in the economy or a potential increase in the inflation. The secondary question, of course, is whether during this 90-day pause, a significant amount of legitimate trade deals can be negotiated and implemented, or whether we are merely postponing the inevitable, and in 90 days, we'll be having the same conversations we had last week. Unfortunately, there's no way to know what the future holds, especially in the current volatile, unpredictable environment that we find ourselves. So with that in mind, I want to remind you that we spend a great deal of time reading through all the economic reports, all the economic data, and monitoring significant movement in the markets to try to consolidate all of that down into a relatively short, highly informative video that we publish here once a week. If you find these videos helpful and informative, again, don't forget to like and subscribe, but also make sure you come back each week and join us and check out the updates. So with that said, as we move into the future, we will continue to focus on the economic data and the changes in the markets to bring you the best information in an understandable format to help you stay up to speed on the markets. So with that, thank you for joining us and have a great week.